Well, what we actually see is that London is the #1 global recipient of cross-border capital in institutional commercial real estate investment. And that is a change, because typically that's the United States, which is a much larger market. So we're actually seeing that demand coming to the UK. The capital is looking at Brexit and saying, it's not fully resolved, but we're not going to have those sort of last-minute deadline kinds of cliffhangers that we were having for years. And so they see that yields are maybe a little bit higher here than in continental Europe. And so actually the capital is here, and it's excited about assets, including offices, which had been, of course, last year a very big question mark.
Brian, when it comes to Paris, this has been called out in the report, a better performance than last year and closing the gap with London. I was just in Paris on Friday, and it looked like things were almost back to normal there as well. What are you seeing in terms of the demand side, and what are the factors that support Paris?
Well, Paris is just an incredibly diverse economy. It is a very well-balanced economy. It is the clear, primary global city of continental Europe. And that diversity has really benefited it. It is also perhaps on the margin benefiting a bit from some financial service job creation that would have otherwise gone to London, but that benefit is being spread among a number of continental European capitals.
Can we talk about the laggards now, those that where we're seeing this polarization affect? Which cities are being left behind in Europe and why?
I think that the biggest challenges are in places that don't have that sense of place and vibrancy. They don't draw people into them by coming together. There's not a point in commuting into them compared to staying from home and sticking on Zoom. We also see general weakness in Central and Eastern Europe. These have been high growth cities in general, but they really struggle in our evaluation because of human capital deficiencies that they have.
So which ones were the weak ones? Just call out the names for us.
It's mainly, I would say it's smaller cities in Eastern Europe, places like Ostrava, even larger capital cities like Bucharest. These are places that have really just don't score well in terms of population growth, the wealth metrics and the human capital metrics.
Just quickly, if you are looking to invest over the next 12 months, so which city holds the most appeal for you at this stage?
London is our top pick in Europe and really globally. It's a fantastic city. It's seen an incredible rebound from COVID, despite the fact that cases remain high, despite the fact that last year it was a big question mark as to how it would perform.
Brian, thank you so much for spelling that out for us. So Brian Klinksiek with us, Head of European Research and Global Portfolio Strategies at LaSalle. Coming up on the show, President Joe Biden is set to decide this week whether Jerome Powell gets another term leading the Federal Reserve, while Lael Brainard has emerged as a strong challenger supported by progressive Democrats. We'll dig into that next.
This is the story of waterborne crude oil and the benchmarks that reflect its market value, so you can act with confidence. See the whole story online.
We'll be following the major international championships, the star drivers, look at the technology behind the world's best race cars, head into the race shops. It's all on the fastest show on earth. Mobil 1 The Grid.
We've been seeing this growth in retail investors.
Betting big on stocks.
The volatility is what's drawing a lot of crypto investors in South Korea.
Challenging market rules.
Short selling has come back to the South Korean stock market.
And setting global trends.
Audiences around the world are falling in love with Korean stories.
Get the pulse on South Korea. K-Beat. Mondays on Street Signs.
The US House of Representatives has passed President Joe Biden's $1.75 trillion Build Back Better bill, a wide-ranging social spending package which includes investments in healthcare, childhood education and combating climate change. The bill will need to pass the Senate, where a defection from any of the Democrats or independents could still sink it. The package could also be altered by the senators, which would send it back to the House for another vote. US President Joe Biden is also expected to announce this week who should lead the Federal Reserve after the incumbent chairman Jerome Powell's term comes to an end in February. Powell is in a strong position to be reappointed for a second four-year term as Biden reportedly looks to secure continuity at the central bank. But the progressive Democrats are pushing for Fed board member Lael Brainard, who is considered even more dovish than Powell in her monetary policy views. Sami Shah joins us now, chief economist from Lombard. Sami from Lombard Odier. Sami, let me ask you about the sort of position that Powell is in. Do you think he is in a strong position, and would you expect that he would be renominated?
Yeah, that's our expectation, basically, for a couple of reasons. But, the first one is policy continuity. The second one is the comfort to have someone that basically, has done the policy that the Democrats would have expected. No real surprise there. And Powell has been nominated by Republicans. So basically that avoids having a pushback from the other side in terms of policy. It's really comfortable to keep it as is, and I would say there is still a lot of reframing by nominating some board members. So I think the Democrats can be satisfied with Powell and reshaping the rest of the Federal Reserve's board.
There's already been a lot of tension between the doves and the hawks at this point as we watch escalating inflation, with the hawks concerned that we're looking at a runaway inflation story entrenched in the system. Do you think that does pose a challenge for Brainard, given her fairly dovish views?
It does slightly, but I think this administration has in mind that what counts above everything is employment. And basically this Fed has set a new framework where it gives more importance to the employment side of the story versus inflation. So I think they want people in that will be patient on inflation, at least until we get clear signs that employment is decisively back to full trend. So I think it's very clear that they will go for someone that favors employment over inflation and that is patient.
Sami, we often talk about this third mandate where it's the Federal Reserve for the world, in some cases for the central bank, but we do have very mixed policy taking place from other central banks. Some are expected to move South Korea and New Zealand on the radar this week versus a situation in Europe where we've got a very dovish approach to monetary policy given the COVID situation still and fresh lockdowns that may destroy more output this year. How does the Federal Reserve look at its role at this point, do you think, as a global player for central banks?
No, frankly, I think it is true that the cost of capital in dollars is extremely important for the rest of the world, but the Fed has a twin mandate. It's a domestic mandate, and obviously they will stick to that mandate and to the shape and the state of the U.S. economy. And it's clear that, as for other central banks, the US economy is emerging from a state of crisis into, I would say, something more benign. So it's natural to remove some of the emergency measures, again, to be more coherent with the fact that the economy is doing relatively well. But when you do so, when you remove medication, you do it gradually. And so, the first step is obviously to remove the quantitative easing. The second step will be to raise rates after a pause. So, they've communicated that well to markets, and they have to keep a very flexible and gradual approach, because we don't know how some of these risks will pan out between the pandemic, between slowdown in China. So I think it's fair to keep that very flexible approach.
The risk then around the COVID situation in Europe, because we've all closely watched the events in Austria, and I was just talking to an expert before saying, well, really this time around when you look at Europe, it's going to come down to vaccination rates and the individual mandates around mask wearing and the use of health passes. It's very hard to look at Europe as one big collective this time round, because it's quite different when you look at the various metrics. How do you weigh it up then in terms of economic performance in coming months, as we consider that there could be a very negative situation in one country versus another?
Well, that's the key angle. I mean, it is true that the situation is very diverse, but the reality is this is the fourth or fifth wave, depending on some countries. And we've learned a couple of things from the precedent waves, is that, the impact on economic activity, on growth, on jobs, and on corporate profits isn't as disruptive as the first wave. So that's the first thing I would say. The second thing is, once these waves pass, then you have a catch-up effect. So I would say the long-term damage from these waves is now relatively controlled. I wouldn't say that, depending on sectors, I wouldn't say that obviously it's inexistent, but I would say it is relatively kept under control. And this is how I would see, we will look through these waves, at least for now.
Sami, but if we consider the situation to date, what we've had, a very negative playbook for these nations, and then a response at a European level to try and inject money back into the system to help these economies regroup and recover in future. If some start to reverse, don't they require more fiscal spending? Isn't the current money that's been pledged just not going to be enough in that situation?
No, I don't think they have any limits. You're totally right to mention that. Again, we know that the short-term disruptions are measured. We know that there's a catch-up effect in the long term. And we also know that, you need to support the income loss that comes from these waves. We've had a pretty severe wave during the summer. And again, the economic impact, the medium-term economic impact of these waves was relatively measured. And we expect the same for this one. But you are right. It takes flexible monetary and fiscal policy to make sure that the damage from these waves remains measured. And this is what we had so far. So this is what we continue to expect. If they need money, the money is there. If they need flexible central banks are flexible.
Just very briefly, can you give us a view on oil and the import here? Because we've seen it flip a little bit weaker on the back of this economic story in Europe with COVID restrictions.
Well, there are two things. There's indeed the demand side, which, again, maybe there's expectations of lower demand on this COVID wave. And on the other hand, you are getting slightly more supply, right? The OPEC Plus, month after month, is going to match the recovering demand. So on both sides, we always said that a price above 80 was a little bit overshooting our kind of fair value target, which remains around 70.
Right.
So what we feel now is a bit of a normalization.
Sami, thank you so much for joining us. Sami Chow with us,
Thanks.
Chief Economist at Lombard Odier. Quick look at futures before we let you go, and we can see how we're